Hey everyone, and welcome to this explainer. If you've ever stared at a trading chart and just felt completely overwhelmed by the chaotic noise of the market, well, you're in exactly the right place. Today, I'm going to be your mentor. We're going to map out a highly structured, step-by-step path to mastering one of the most popular indicators in the world. We're basically going to build a completely objective framework that takes the emotion, the second guessing, and the stress completely out of your trading. So here's our roadmap for today. First, System 1, writing trends. Then, System 2, spotting reversals. System 3, filtering the noise. Then we'll look at the EUR/USD setup and wrap up with the 5-minute routine. Let's dive in. Okay, before we jump into the actual systems, we need to understand our tool, MACD. It stands for Moving Average Convergence Divergence. Usually, you'll see it sitting at the bottom of your chart with standard settings of 12, 26, and 9. Now listen, this is absolutely crucial. The MACD is not a crystal ball. There's no magic here. It doesn't predict the future. Instead, think of it like the speedometer in your car. It simply confirms the speed and direction of the current price action. It measures momentum. Honestly, if you can just remember that one fact, you're already way ahead of the pack. But that brings up a pretty painful question for a lot of beginners. If the MACD is such a great tool, why do most novice traders get completely chopped to pieces using it? I mean, if you've ever tried it and lost money, I want to completely validate your frustration. We've all been there. The ultimate trap is using the MACD in total isolation. Novices see a basic crossover signal, they blindly enter a trade, and bam, the market immediately whipsaws them. It jerks the price back and forth because they're stuck in a sideways ranging market. They lack a structured filter, so we're going to fix that right now. All right, System 1, writing trends. So this trend writing system, it's not super glamorous, but man, it is highly consistent. The absolute foundation of it all is the zero-line rule. On your screen, just look for that horizontal line right in the dead center of your MACD panel. If the MACD line is above 0, you only look for buy setups, period. If it's below 0, you only look for sell setups. This is a non-negotiable law. It instantly stops you from fighting the trend. Now, once you know your direction, you're looking for a MACD crossover for your entry. But here is the real secret sauce. You only want to take crossover signals that happen close to the zero line. Why? Well, because a crossover that happens way up high or way down low usually means the move is already overextended. You're late to the party. A crossover right near the zero line, that means momentum is freshly resetting. You're catching the very beginning of the next wave. And when you do enter on that confirmed crossover, execution is literally everything. You've got to place your stop loss safely beyond the most recent market swing, so just below the recent V-shaped valley for a buy or above the recent peak for a sell. Then strictly enforce a minimum risk-to-reward ratio of 1 to 2. For example, if you're risking $50, you need to be targeting at least 100. That simple math right there is what keeps you profitable over the long haul, even if you don't win every single trade. Moving on to System 2, spotting reversals. Okay, now that we know how to safely ride the trend, let's talk about catching major turning points early. We do this by spotting divergence. Divergence is simply when the price on your chart and your MACD indicator start moving in opposite directions. For bullish divergence, imagine the price dropping to make a lower low, but your MACD makes a higher low. It's like a coiled spring getting ready to pop. Selling momentum is weakening. For bearish divergence, the price pushes to a higher high, but the MACD makes a lower high. It's like a hot air balloon running completely out of gas. And you can actually see this exhaustion playing out physically. Once that divergence forms, look closely at the histogram bars. When you see shrinking histogram bars, think of them like descending stairs. It confirms that momentum is literally bleeding out of the market. The current push is just running on fumes, and a reversal is starting to happen. But, okay, I need to put my striked mentor hat on for a second here. You absolutely must wait for confirmation. Divergence alone is just a warning sign flashing on your dashboard. It is not an excuse to slam on the brakes and jump straight into a trade. True, lasting trading discipline means waiting for a zero-line cross or a clear MACD line crossover before you risk a single dime of your capital. Which brings us nicely to System 3, filtering the noise. To avoid those brutal fakeouts we talked about earlier, we use the system strictly to separate the absolute best setups from, well, the garbage. The core of this filter is multi-time frame alignment. Before taking any signal, look at the next higher time frame. Trading the 1-hour chart? Check the 4-hour MACD. On the 4-hour, check the daily. If your immediate signal says buy, but that higher time frame MACD is pointing down, skip it. Do not take the trade. Fighting the bigger, heavier trend is a battle a novice will almost always lose. Just don't even try it. To really cement this, think of grading your setups like a test. An A-grade setup, the higher timeframe MACD perfectly aligns with your trade, and the signal happens exactly at a key level of support or resistance. That's when you enter with confidence. A C-grade setup, on the other hand, means the higher timeframe conflicts, and the signal is just floating out in the middle of nowhere. Skip those entirely. Be patient. Let the market come to your levels. All right, let's put it all together. The Euro-USD setup. Let's bring all this theory straight into reality by walking through one master setup. Here's how a disciplined trader does it. Step 1. Check the daily chart. MACD is above 0, so our bias is purely bullish. No selling today. Step 2. Drop to the 4-hour chart. Mark a clear support zone. Step 3. We wait. Eventually, price touches that support, and beautifully, a bullish divergence forms. Step 4. We wait for confirmation. The MACD line crosses the signal line. Step 5. We finally enter long, putting our stop loss safely below that support zone. And Step 6. Target the next resistance level, locking in a clean 1 to 2.5 risk to reward. Methodical, objective, totally stress-free. And now for my favorite part, the 5-minute routine. If you want to do this every day without losing your mind staring at candles, here is your blueprint. First 90 seconds, check your higher timeframe bias. Next 90 seconds, draw those key support and resistance lines. Next 60 seconds, drop to your trading timeframe, see if everything aligns. Final 60 seconds, set price alerts at your key levels. Then, actually, this is the most important part, you walk away. Setting alerts prevents that dangerous all-day chart staring. You only look at the screen when the market taps you on the shoulder. I want you to remember this core philosophy. Discipline, not screen time, is what separates profitable traders from losing ones. Mastering the MACD isn't really about mastering math or learning lines on a screen. Ultimately, it's about mastering yourself. Having the sheer patience to wait for the A-grade setups and the discipline to just walk away from the C-grade noise. And that brings us to our final thought for today. The edge in trading? It isn't hidden inside the MACD indicator itself. The edge is entirely in the process you apply to it. So my question to you is this. Are you ready to finally stop chasing random signals and start trading with real structure? Take this framework, apply it to your charts, and just let the market come to you. Thanks so much for joining me on this explainer, and I'll catch you on the next one.